हेलो हेलो। नहीं नहीं सर, बिजी नहीं सर, मैं जब ड्राइविंग में था, शायद मेरा फ़ोन वाइफ के पास था, तो वो उनको ही देता हूँ सर मैं, कोई आता है कॉल तो लिफ्ट करने के लिए, इफ आई एम नॉट इन कार। बोलिए सर प्लीज़ काइंडली। सर मॉर्निंग भेज दीजिए ना सर। हाँ हाँ भेज दीजिए सर, भेज दीजिए। भेज, थैंक यू सर, नमस्ते सर, नमस्ते, थैंक्स। Okay, now let's start with international finance. My question to you is, what is this international finance all about? See, if I have to say something about this, international finance is the study of monetary, sorry, I have to say interactions. Just a second, this is not working properly. So, international finance is the study of monetary interactions between I don't know where it's going wrong. Between two or more countries focusing on areas such as foreign direct investment, FDI, foreign direct investment, focusing on areas. I have to mention areas such as foreign direct investment and currency exchange rates. Okay, you can make a note of this. So what is this like international finance all about? International finance is a study of monetary interactions between two or more countries, and you can understand where MNCs, multinational corporations, these multinational corporations are ones which are in, like I can say, they are incorporated in one nation, and they have different branches, or they operate in different countries, correct? So there, these MNCs have to invest money in different countries. So there, what comes into picture? Foreign direct investment. So if India wants any investment from any foreign company or any multinational company, that will be termed as foreign direct investment, which is important for every country, because FDI comes in a country like developing nation like India. If FDI comes in India, it would create jobs for the locals and also taxes to the government, correct? The jobs for the local is like one of the sources. It can become a probable source of revenue to government in form of taxes, and also the standard of living of people may also improve, correct? So here, that's what it is very important for us to learn about the international finance. Since you as like after cracking the exam, you become a CMA, you would be working in multinationals, and you would definitely there. It is very important for you to understand what is international finance all about. So study of monetary interactions between two or more countries, focusing on areas such as foreign direct investment and currency exchange rates. Of course, Currency exchange rate also is a very important aspect of international finance. Why? Because when a US based MNC has to invest in India, they have to exchange dollar or they have to convert dollar into rupees, and then they need to invest. So definitely they would be considering the exchange rates even. Okay. So if I'm not wrong, you have a good idea about MNCs. Some of the MNCs around the world are Google, Apple, the likes of Google, Apple, and in India we have TCS, Infosys. All these are multinational corporations. Hindustan Unilever. These all are examples of multinational corporations. Okay, these MNCs are massive, large companies with operations in more than one country. Okay, and these are of course usually large companies. You know about them. Excuse me. Now, so this is what is like about MNC. So I've given some good examples. TCS, Infosys of India. I've given some good examples, and these are very big companies. So large employers requires lot of employees. These guys have a very big network around the world. So many of the businesses are interconnected with these MNCs. Okay, so these create an ecosystem actually. So, like generally, the effect of MNCs is positive to economy of the world as a whole. They tend to bring efficiencies of scale to large operations and more efficient distribution network. Amazon, Amazon is one of the MNCs. As a result, more products are available around the world for a lower price. Why? Because they not only produce for their own nation, they produce for the world actually. Okay. So, however, the impact of MNC is felt in both the host country and the home country, and it is not always a positive effect. Yes, because we always have some kind of fear in India if MNCs enter India. See, there was lot of there was lot of this thing like uproar in the previous like governments or previous regime, whereby there was lot of outcry. Many people didn't don't many people did not want the MNCs to come in retail sector. Like they did not want Walmart to come to India because they feared, they had a fear that like the Walmart, if it comes to India, then it may eat away the businesses. So that fear was like it was not that the fear was not like justified fear. It was definitely the concern of the Indian retailers. India is a developing nation, and we have lot many retailers who sell goods in India. So that was they were really concerned about this, and they really did not allow the FDI to happen in retail sector. But in various other sectors, FDI is seen, like in railways, foreign direct investment, like bullet trains are built. In construction sector, various sectors, you can see FDI is coming into picture, and defense sector also foreign direct investment is happening. Okay, so it is good in some ways, but it is even bad because foreign direct investment, if it comes to India, then it creates a big competition for the local companies, and it doesn't allow the local companies to grow. Like many a cases, the local companies have grown, but many a cases it has uh, like uh, it has kind of created hurdles for the local companies to grow. Okay. So the home country of the MNC will receive benefit from MNC's overseas operations. Yes, because if Apple sells, see, day before yesterday, I have even seen like Apple has done a massive sales of iPhones in India. So like these all revenues, what Apple is generating is also it will definitely benefit the home country. Okay, how it benefits the home country? Higher profits and therefore higher taxes collected in home country. Okay, that is in United States. Host country would be India. Home country is always US for Apple because it's incorporated in United States. MNC may bring in positive balances of trade through its exports. Yeah, if at all we are not buying American goods which are made in America, because American goods will be very costly, like because the labor cost and everything is very high. So what they do is they open their like manufacturing units in other countries and they manufacture there. Like they want to take leverage of cheap labor, like China, they have opted China as a destination, and you know China is world's factory now. So what happens if they are not able to export from America, they export their goods from China. The company is making profits at most. Okay. So and MNC also bring other businesses into the country as supporting business to the MNC. Yeah. So you know Maruti Suzuki, when they built a plant, it, they created a ecosystem, like all the car decors to every electronic gadgets and all related to car, the like related products start got like the small scale companies started manufacturing them near to the Maruti's manufacturing plant in Delhi in Gurgaon. Okay, so it is really beneficial. Then what happens to the host country? Jobs created. You see, high tech city. High tech city like is the best example. It's a special economic zone, and like you know SEZ we call, and like various in pharma sector, IT sector, we can see FDI happening. It is creating lot many jobs for the local youth. Okay, local people. Investment of capital and technology in our country. Yes, we get good technology and also capital comes in the country. Balance because now we can export those goods from our country to other countries. Okay, like make like by with the branding called Make in India or Made in India. The presence of one MNC may cause other MNCs to come to host country as well. So that will drive other companies also to come to India. If I take example to really take advantage of Indian market. Okay, and these are all positives for the country. But host country may also have issues like the local industries may suffer. I already explained to you about the foreign direct investment is nothing but foreign investment coming to a country from either MNC or some company of which is incorporated in foreign country. Okay. So here you can see foreign direct investment involves investment by a multinational corporation in real assets like land, building, or plants and equipment in foreign countries, and direct management of these assets by the company. So the management is also done by the company's managers. FDI can be made by buying a company in foreign country or by expanding the operations of an existing business located in the foreign country. Either they can buy Indian company or they can, if some business is there, they can kind of have a venture with that company, a joint venture kind of, and then they can enter. Like I can give a good example to you. Hero was selling cycles in India, and Japanese major Honda was a bike manufacturer. It's a bike manufacturer. So what happened? Hero had a very good network in India because India after independence was only dependent on bicycles. We barely had one or two bikes like Bullet and all, but that was also not affordable by many people. And Hero was selling cycles all over India. It had stores, it had outlets, everything. So Honda saw this opportunity and Honda gave a proposal to Hero like if we both like collectively jointly develop a product for the Indian people, you can manufacture the body parts and I will give you the engine. So Honda wanted to take the advantage of Hero's wide network what it had, and then came into picture the Hero Honda, the joint venture of Hero and Honda, and you can see rest is nothing but the history. You can see how well these bicycles delivered, and how people were satisfied with this. And like some years back, these both companies, they kind of they split, and now they are selling their own motorcycles in the market. So that's what. FDI is different from foreign portfolio investment. Foreign portfolio investment is an investment in, yeah, securities or bonds of a company in foreign country, and it is passive investment. That means people want to hold it for a long period of time. Foreign direct investment is nothing but investing directly into the business or buying some company. Okay, foreign investments are funded by parent company resources, sales of common stock in foreign country, sales of bonds in foreign country, borrowing in world financial markets. So these ways the foreign direct investment is done. So managing foreign operations is more difficult than managing domestic operations, of course, because of issues involved. There are like many issues like tax issues, tax related issues, government related issues. There are a lot of things. Okay, and sometimes the investment what they do even doesn't prove to be successful. Benefits of FDI: new sources of demand. Yes, because what happens if you are able to sell all the products in your own country, and then again you can produce more, or you can have surplus production, then definitely you can look out for new markets, and you can explore new markets by merging with some of the companies in already which is already operating in some country. You can collaborate with that country, like Tata is an Indian company, and Sky News is like of UK. So they both collaborated, and Tata Sky came into picture. Okay, so Sky Network. So in this way they can collaborate, and they can sell their products in other countries, or demand. Definitely they can create demand in other countries. They can enter into profitable markets. Monopolistic advantages, like they can sell goods with different packaging and different branding, or with different features. Okay, they can definitely bring some product which is unique to the local market. Reaction to trade restrictions, yes, like they may face this even trade restrictions by many countries who doesn't want these companies to come and dominate their local markets. Then comes the international diversification. Yes, they are diversifying internationally, of course. Economies of scale is also happening. Why? Because these guys produce like in a country with they don't compromise with anything, not even with the technology, not even with like hiring like very good professionals. So they want everything to happen very efficiently. So economies of scale, they want to achieve that. Availability of lower cost foreign factors of production. Yes, land labor organization, land labor. They can get very cheaper labor in a country like India and China, and they can take advantage of it. Availability of lower cost foreign raw materials. Yes, that is also one of the factors which is driving them to come to the nation, to these countries, and invest. Availability of foreign technology. Yes, technology gained from foreign plants. Even if they find something in India, even they can get advantage of that, or Indians can also get advantage of foreign technology which is coming to the country. Take advantage of exchange rate movements. Yes, now this is one of the biggest factors. If American dollar, $1 is like 70 right now, and in future dollar appreciates, then if $1 becomes 80, then they can invest more money in India. Okay, with less amount, with less dollars, they can like offset exchange rate fluctuations, incurring cost in. So what they can do is they can instead of, see, definitely exchange rate movements can go either way. Dollar appreciating is right, that's good, but if we say dollar can also depreciate, like $1 can be sold for 61, then what? So then that time it is better. What they can do is they can earn here, and they can invest that in the same country. They can increase demand fluctuations caused by exchange rate fluctuations. Yeah, when like exchange rate fluctuates, the fluctuation causes a country's exports to, like, so of course if India, $1 is equal to 70 now, but $1 goes for 80. So that means Indian currency has depreciated, American currency has appreciated. So what can happen is Indian exports become more cheaper in US, so they can export more. They can take that advantage. You can see, so interest rates in another country may be more favorable. Yeah, they may get more interest in India if they invest in India. whatever the surplus they earn. Now, now comes the different risk of foreign direct investment. There are four risks: country, political, financial, exchange rate risk. Country risk is nothing but is impact on a multinational firm's cash flows caused by environments in the countries. Like I can say, in which the company operates. Country risk an important consideration in decisions both to enter a country and remain there. If the risk level of a country where an MNC does business begins to increase, the MNC may decide to divest. That means they want to sell off their companies and they want to move away. Country risk factors, the biggest one is political risk. You know, I can take the example of North Korea. Do you think any company wants to invest in North Korea when King Jong Un is one of the dictators there? No, never. Okay. Now what can happen is these dictators, they are cranky people. What they can do is whenever there is a sanction what America wants to put on them, or there's a like these countries don't have a good relation with developed nations like America and all, because you know two types of ideology, communism and democracy, they don't gel with each other. So what they can do, they can block the fund transfers, and they can kind of put regulations on the company, some corruption charges, some bureaucracy. They are like these like in India. India, it's one of the biggest challenges for MNC is corruption, bureaucracy, red tapeism. All this, even these companies don't want these hurdles. Financial risk is nothing but the interest rates may kind of decrease. Suppose they want to invest in India, and they want whatever the surplus they get, they want that to deposit or again reinvest. So if the interest rates decrease, that doesn't go well for them. Okay. See what happens even if interest rates are very high, even that is not good, because loans, people will not be taking loans and trying to invest, correct? So higher interest rates decrease the demand, and lower interest rates increase the demand. Exchange rate, I have discussed with you, the exchange rate fluctuations are a big matter of concern for any company to invest in a country. If $1 is 80, they are very happy to invest. They get more rupees for dollars. If $1 is 60, they are not happy to invest because dollar is depreciating there. They get less rupees and they can invest less. Okay. Then they have got the benefits of international diversification because they get new market, and like new assets are created, etc. Okay. Are you following? Yes.
Yes, sir.
Multinational capital budgeting. Yes. See, capital budgeting already we have done the chapter. Okay. So these companies, which are multinational companies, can also try to see if they want to invest in some of the countries. They can first verify whether the project in the project what they are considering to invest in any country which they are considering, whether that project is going to be a profitable project for them or not, and they are going to bring all the risk factors into consideration, and based upon that they are going to fix their required rate of return, which they are going to use as a discount factor. So you understood what I'm saying? So if they want to start a project in India, they definitely have to invest money, the capital, and when that is called outflow, and that outflow would definitely give inflows, and those inflows have to be discounted, and discount rate can be fixed only after considering all the risks like financial risk, political risk, all the kind of risks. Okay. Sovereignty risk, etc. Then even some other considerations in multinational operations. Of course, they also have to face like this scenario whereby the laws in different countries may differ, and they have to accustom or they have to kind of make themselves habituated for those laws. Okay. That is also one of the aspects. Now, international buying and selling, foreign exchange market. Just a second. So now comes the foreign exchange market. So in order for international trade to occur, currencies of the countries involved must be easily converted. So conversion from one currency to other must be done at a determined prevailing exchange rate. So there are some countries which fix the exchange rate, that's called pegged system. There are some countries which do have which do not go for fixed exchange system, they go for flexible exchange rates, like India. India has left the market forces to decide what should be the exchange rate for $1 in terms of rupees. Okay, so we haven't done any kind of fixed agreement. We have left it on the market forces to decide. So the exchange rate between any two countries is simply the number of units currency. So if at all I speak about, if you want to buy one apple, you have to spend suppose 30 rupees. So 30 rupees, if you give, you can get one apple. That is, for one apple, you are shelling out 30 rupees. So this apple can be exchanged in terms of rupees. In the same way, if you want, you can consider $1 as one apple. $1 if you want to buy, you have to shell out 75 rupees. So $1's value is 75 rupees in rupee terms. So this is called the exchange rate. Okay. Currencies can appreciate and currencies can also depreciate. The terms used to refer to changes in exchange rates are appreciation and depreciation. As I can say, if you are buying $1 for 70 right now, that is the spot rate, spot exchange rate. If you are buying $1 for 80 rupees, that is the exchange rate after suppose 2 months, maybe. So this clearly shows that the rupee has depreciated and dollar has appreciated because you're paying more rupees, 10 rupees more to buy $1. And if $1 is 60, the dollar has depreciated and rupee has appreciated by 10 rupees. You're paying 10 rupees less to buy $1. Okay. Direct quote. If at all you are in India and you want to buy $1, so you will be going to bank and you'll be asking how much is $1 for. So $1 is for 75. He'll be saying this is called a direct quote. That means you yourself in your home country is asking like the rate for a foreign currency. It's called direct quote. And if I ask you 1 rupee is how many dollars? So what answer you can give? So you can do one thing, 1 by 75 you can do. Why see $1 is equal to 75 into 1 rupee. I can write this. If I bring 75 here, it becomes $1 divided by 75. So how many rupees are getting? Can you calculate? 0.0133. So 1 rupee is this many dollars. Okay. So this is called indirect quote. Please make a note of this and go for this question. Come on. Okay. So this is a question. Assume the exchange rates between US dollar and the following two currencies are as below. Exchange rate in respect of 1 unit of foreign currency is written as like if you want to go to a bank, if you are in United States, your local currency is dollar. Like I said, if you want to buy dollar in India, you will ask the code for dollar. That means you'll be asking the bank, like how much is how much how many rupees you charge for selling a dollar. So in the same way, the people in the United States will ask how many dollars would you accept to give me £1 or some other foreign currency. So this is direct code. What is this? Direct code. That means you in your home country are asking the code for foreign currency. It's a direct code. And vice versa. Reverse of that is indirect code, which they have done here. Okay. So if £1 costs this much dollars, so $1 costs 1 by 0.90 pounds. Okay. So you can get the answer for this. Come on, see this even. We'll move forward. Are they following?
Yes, sir.
Yeah. Now comes the next concept whereby you can find out the appreciation or depreciation rate of US dollar relative to euro. That's what they have taken. So what you can do is, you can see it. This, what do you mean by this? You know, US dollar for 1 Canadian dollar. If I write like this, 75 rupee for 1 USD, that means you need to pay 75 rupees for 1 US dollar. Okay. So that is what. So like for 1 Canadian dollar, no, they have a different version. My God, different books have different version. Just a second, let me tell you about what they're saying. Horrible. In CFA textbook or other books, we have different notion. Okay, no worries. I'll explain you what is happening here. So currencies are traded in pairs. The exchange rate between a pair of currencies listed on foreign currency exchanges. In any listed pair, the first currency. So please understand. Now we will go with the notion of our book. Okay. The first. So here, like the first currency is the base currency. Am I right? And the other currency is called the quote currency. So I'm asking the quote for $1 in terms of rupees. So quote for $1 in terms of rupees is 75. So this is the base currency, this is the quote currency, and they have given 1.12, which means you need to pay $1 or 1 United States dollar for 1.12, buying 1.12 Canadian dollars. Okay, and it costs this much to buy 1 US dollar. In the same way, so please understand this terminology. I'm writing 1 USD 1.12. I'm writing it here. See what they are saying, you know, you have to get $1 to buy 1.12 Canadian dollars, or you have to take 1.12 Canadian dollars to buy 1 US dollar. Both mean the same. Okay. So if I am in Canada, it will be 1.12 Canadian dollars for 1 USD. Got it? Please tell me yes or no. Hello.
Yes.
Yeah. So that's what, like, they have given the things here. So now they're asking you to find out the increase or decrease, appreciation or depreciation in the currency. Okay, this is done now. This we understood. So we can directly understand this. In this example, the appreciation and depreciation rates of US dollar in respect to euro and appreciation or depreciation rates of euro in respect to US dollar are calculated. If at all this is given, so this is base currency, this is quote currency. For 1 US dollar, you have to pay, okay, this they have given. So this much dollars would buy 1 euro. Okay, that's what 1 euro is equal to this much dollars means like you would take this much dollars to buy 1 euro. So the value of the base currency, the euro. So now they have given two rates. Previously, you were paying $0.60 to buy 1 euro. Now you are paying $0.66 to buy 1 euro. So euro has appreciated because you are paying more dollars to buy 1 euro. Okay, so that's what. So now what we'll see is this is like one by this dollars will give you 1.65. So 1 US dollar is equal to 1.65 euros. Okay, that means to buy 1.65 euros you have to pay $1, and to buy 1.50 euros you have to pay $1. So what has happened here, to calculate whether US dollar is appreciated or depreciated against euro in February and by how much amount, set the US dollar equal to $1. Okay, and since in the quote the euro is equal to 1, divide 1 by the quoted amount to convert it to a quote where US dollar is equal to 1. That means 1 US dollar how much? Okay, so 1 euro, so it like if we divide 1 by this, so what are you getting? To buy 1 US dollar, so I'll write this 1.65 for 1 USD, 1.50 for 1 USD. So what are you understanding by this? Previously you were paying more euros for $1, now you are paying less euros for $1, correct? So what does it mean? That dollar has depreciated, correct, against euro. So now we'll be finding out the appreciation and depreciation, how much the euro has appreciated and how much the dollar has depreciated. So how will you find out? You will take this course. So euro has appreciated by how much? So we will take the euro in terms of dollar. So this was the quote. So we will see this minus this by the previous price in February. You can see that the euro has appreciated by 10.07% against dollar. Now a question I'm asking you, euro has appreciated by this much. So do you think dollar has depreciated by 10.07? No. Euro has appreciated by 10.07%, agreed, but dollar has not depreciated by 10.07%. It's not the same. To know by how much the dollar has depreciated, you have to find out the euros in terms of $1. This you should always remember. Please understand. Previously, we had 1 euro in terms of dollar. That is 1 euro was 0.60. And in second case in February, 1 euro was 0.67 something. This was euro in terms of dollar. Now we have converted dollar in terms of euro. That means $1 is how much euro? Previously it was 1 euro was how much dollar? Now it is $1 is how many euros? So in this case, we got the indirect quote. Here it was a direct quote. We got an indirect quote. Okay. We've got dollars in terms of euro now. So in this case, what you'll do, of course, it has depreciated, correct, from 1.65 to 1.50. So the difference of this divided by the base would give you how much the dollar has depreciated against the euro. Okay, very important question. Please go through this. Now we can like kind of wind up after this. Continue tomorrow. Finished? Hello. Yes, yeah, then Smriti, we will continue the class tomorrow. You can go till here. Today you can you can refer till here. We'll continue tomorrow and we'll try to finish like more topics tomorrow. Okay.
Okay, sir.
Thank you.
Okay, sir. Thank you.